Welcome to Module 7, everyone. What we're going to do here is basically take an idea we alluded to back in Module 2, the concept of chart reversal patterns, and we're going to look at one in particular a little more intensively. So we're going to look at the standard and sloppy 1, 2, 3 top and bottom patterns, and we're going to look at ways that we can use MACD to identify the turning points, to make the pattern clearer in our minds as we see it unfold, and most importantly of all, how to trade it and maneuver around it. So what we'll do here is we're going to start with a standard 1, 2, 3 bottom pattern. And this depicts more or less what's going on with price action on your chart. The first thing to happen is that price makes a new low. It drives down to a level at which it finally achieves support, and for whatever reason, we're not terribly concerned, but we just see signs of support coming in before price then bounces off that level to a new interim high. This will often take the form of a classic Fibonacci style retracement, not always, but very often. So if you see this kind of pattern unfolding, a sharp drive down, price bouncing up, you'll want to go ahead and apply your Fibonacci grid and look for resistance at a critical level such as 38 or 50. Once price has hit that number 2 position and found interim resistance, it will then drift back down into the area of old or prior lows. It's testing for support, testing to see if support will come in and allow the market to then move higher. So if you're a newer trader, it's very important to bear in mind that to qualify as a standard 1, 2, 3 bottom, the number 2 position must be higher than the number 1 position, the number 2 position must be higher than the number 3 position, and the number 3 position must be higher than the number 1 position. If the number 3 was at or below the number 1, you would not have a standard 1, 2, 3 bottom. You would have either a double bottom or a sloppy bottom. And we're not going to be looking at double tops and bottoms because we're just going to focus on this one particular type of chart pattern. But that, in a nutshell, is what a standard 1, 2, 3 bottom reversal pattern looks like. Here's what happens when the different positions in the 1, 2, 3 bottom don't line up as per the standard pattern that we just looked at. This is a variation we can refer to as a sloppy 1, 2, 3 bottom. Now, what's going on here? This is a kind of a tricky setup, really. We had price fall down to the number 1 position and find some interim support there. It then went about its business of bouncing off as a retracement against that move to the number 2 position, just like in the standard 1, 2, 3 bottom. But then what happens, it's a little bit almost like a bit of a ruse or a bit of a false signal. Price does not find support midway between 1 and 2. What it does is it comes down to the area of the prior or old low. And what's going to happen here is that a lot of traders in the market, particularly breakout traders, they're looking at this price level as very significant because what they're going to do is a lot of these people are going to put resting sell stops somewhere in this neighborhood, probably a few pips underneath this number 1 position, thinking that once price has broken this old low, that's very bearish. What then happens is the market does go down a little bit further, but then it finds support, not above the number 1 position, but rather below it. So what's going to happen here is a lot of people are going to get burned unless they have very fast reflexes or are monitoring this thing in real time. Because if you put a resting sell stop below this number 1 position thinking that's a bearish breakout, if you just do that and then go away for a while, what could very easily happen, depending on what kind of time frame this is, perhaps an intraday chart like a 4, 3, 2 hour chart, whatever, this thing doesn't have a lot of gas left in the tank before it hits a subsequent low or a subsequent support level, bounces off that, heads right back up through the number 1 position, and if your sell stop was here with a protective stop above this number 1 price level, you're going to quite quickly get taken out of the market here with a loss. So these kind of patterns, when they happen, are pretty tricky. You really have to read the clues and the signs and multiple time frame analysis and so forth. And again, MACD can help us navigate through them. But what's basically happened is we see a deviation from the standard 1, 2, 3 bottom pattern because the number 3 actually ends up being lower than number 1. It looks like a bearish continuation pattern, but the downside dries up pretty quickly and then it reverses and heads off in the other direction. So here's how the positional turning points line up. 2 is always greater than 1. But 3 is lower than both 1 and 2. Now, if the number 3 position aligned perfectly with the number 1 position here, of course what we would have is an actual double bottom. We're not going to go over that type of pattern in detail here. We just want to look at the specific 1, 2, 3 patterns. But if you had 1, 2, 3, that would be a double bottom, and that's also a fairly exciting reversal pattern when you see it. So that is a sloppy 1, 2, 3 bottom. All these patterns we look at inevitably end up involving the principle of symmetry, and this demonstrates it yet again. In other words, whatever we have on a bottom, we just flip it over, and there it is on a top. This is a standard 1, 2, 3 top. So we can grind through this pretty quickly since the concept's already familiar. We have price rallying to a number 1 position, a new high, from which it retreats or retraces down to a number 2 position. Price will then rise up and test the prior highs and come up short. It won't go as high as the number 1 position or go higher. It'll come up short relative to the old high. And if that's as far as it's going to go, if it's not going to go any higher, then you can see a lot of traders are bailing on the long side, and we now have selling pressure coming in. The number 3 position serves as resistance, and as price breaks through the number 2 position, it's pretty much all downhill from there. So in a standard 1, 2, 3 top, the number 2 position is always going to be below the number 1 position. The number 3 position is always going to be above the number 2 and below the number 1. If number 3 was on the number 1 position, we would have a double top. That's what a standard 1, 2, 3 top pattern looks like. Here's the last of the 4 reversal patterns, chart patterns that we're going to look at here. This is a sloppy 1, 2, 3 top. It doesn't often get referred to it that way, but if this is just the inverse of a sloppy 1, 2, 3 bottom, then we may as well apply the same terminology here. So price makes a new high at number 1. It finds resistance there, which is temporary. It retraces part of the way to number 2. And again, we would probably want to put our Fibonacci grid on this if we suspected that a retracement was underway. It's always a very good technique to do that. Because what you might very quickly find is when you attach the anchor points to here and here, if price comes down and touches precisely on the 50 level, I mean, you're just looking at that and going, okay, I think I know what's going to happen next. What does happen next in the case of this paradigm is price rises off the number 2 position, and just like in the case of a sloppy 1, 2, 3 bottom, what then happens is breakout traders get sucked into the wrong side of the market. Okay, they see this old high and they see price breaking through it, and they go, aha, this thing has still got legs. So they might just jump in here just in real time, or have a resting buy stop just above the number 1 position, or maybe even just below, for all I know. And they think that, you know, we have kind of like maybe Elliott wave patterns or something unfolding here, and they think this thing is going up a lot higher. What then happens in this sloppy pattern is a new high is created at the number 3 position above the number 1 position. But instead of perhaps coming back down and simply testing the number 1 level, broken resistance now as support, which can happen, and that's a really good buy opportunity actually if the trend remains up. But instead of that happening, price just punches right back through number 1, and it keeps on going. So anybody who bought here, put a protective stop underneath the number 1 position, and just held on to it with the expectation of like a position trade or something, if they're not watching this pretty closely, they're going to get taken out. So that's what a sloppy 1, 2, 3 top looks like. I've identified a total of 3 very specific applications of MACD that we can use with these 1, 2, 3 top and bottom patterns to help us navigate our way around them and identify the individual turning points as well as to trade the thing. So the first of those being, again, this is not a new idea, but using MACD crossovers. What will often happen is whether on the time frame we see the 1, 2, 3 pattern or on a lower time frame, it is often quite possible to draw trend lines and see trend line breaks on each of the number 1, 2, and 3 positions. And what we do is we use these crossovers to validate those trend line breaks, which again just really help us clearly identify those turning points and make the reversal pattern just very distinctly obvious what's going on. In the case of sloppy top and bottom patterns, what we'll often see is a really nice divergence pattern on MACD to price, which will flag that new high or low as basically a false level. In other words, there is reduced momentum in achieving that high or low. There's no follow through to the upside or the downside. So we can look to divergence patterns to help us flag those number 3 positions that appear to be false in the case of a sloppy 1, 2, 3 top or bottom. Finally, we can look at the histogram waves. A histogram wave just being, those clusters of bars that are getting first progressively lower than higher or vice versa. When they line up with price action itself in a number 3 position, it's almost like the 2 indicators are reinforcing each other, price and the histogram, and it can just help us read the momentum behind the establishment of a number 3 position. So those are the 3 primary applications I've identified for MACD with these reversal patterns, and no surprise here. Let's turn our attention to some chart examples to see how these work.